for those of you who don't know me, I'm a tax and estate planning attorney, predominantly in Southern California, but licensed in 6 different states. For those that like to look up credentials and things of that sort, I am one of less than 100 attorneys in the state of California who is a state certified specialist in the areas of estate planning, trust and probate law, and in taxation law. So all things relevant to the discussion of trusts and taxation as we're going to be talking about today.
Hey everyone, if you got value out of this, please like, share, subscribe, and comment to help us with the algorithm so we can find more people like yourself that are trying to find faith in the financial services industry once again. All right, today, irrevocable, non-grantor, complex, discretionary, spendthrift trust. This is huge on social media, huge. So real quick, Mark Ziebold here at JDLLM, right? If you can, just kind of give me a little bit of credentials on why you should be talking on this matter.
Sure. For those of you who don't know me, I'm a tax and estate planning attorney, predominantly in Southern California, but licensed in 6 different states. For those that like to look up credentials and things of that sort, I am one of less than 100 attorneys in the state of California who is a state certified specialist in the areas of estate planning, trust and probate law, and in taxation law. So all things relevant to the discussion of trusts and taxation as we're going to be talking about today.
Sounds good. Well, I'd like for you to give me like a quick 1 to 5 minute elevator pitch on what is wrong with this dude. I won't say the guy, but what's wrong with this specific trust, and then I'll let you get really technical on the back end.
Sure. And what I find is that there's a few different dudes or guys out there pushing these types of things at the moment, and they're all a little bit different. So we're going to spend most of our time today talking high level, but in general, I think this is the problem. Is that if you go to any competent attorney or any competent person who works in the area of trusts, and you come in and you say, I want a trust that is a separate taxpayer from myself, that's the non-grantor that we're talking about. Any attorney who's worth their salt or any person who is competent in this arena is going to write you a complex, non-grantor, irrevocable, discretionary, spendthrift. If you want to add the word dynasty, if you want to add the words complete or incomplete gift, you could add all these different adjectives. It's all marketing, because at the end of the day, most trusts that are fitting this profile fit all of those different adjectives. The question comes down to, once you have this type of trust, how does your CPA, your enrolled agent, or whoever's doing your tax returns, how do they interpret the tax code with regard to how they report the gains and losses inside of the trust at this point? And I think the biggest issue we face is that you have some people that really aren't familiar with the way that the tax code is set up, giving tax advice to thousands of people that really flies in the face of how the IRS has written the tax code. And you're going to have a lot of people who are in major trouble with the way these trusts are being promoted out in the marketplace.
Ooh, so I'm going to go ahead and just give you the floor. You can talk about the 5 different trusts in one, which we all know they're just features. I'm just going to let you rip on it.
Sure. Well, like I said, to rip on it would be like ripping on my own work in a lot of sense. So I'm not going to necessarily rip on the trust itself, but I think what we have to predominantly spend our time focusing on is the tax code. And I'm going to give citations, and then I know that many of our audience aren't necessarily going to be watching, they're going to be listening. So I'm going to just read a little bit of the code sections I'm citing at this point, because I think that'll give you some flavor of why I think that people are misinterpreting the tax code with regard to these types of trusts. So before we even get into trust taxation, unfortunately, we have to do a little bit of pre-education, and we have to talk about what does the tax code really say globally with regard to income and things of that nature. So I can remember back in my very first tax law class, where we started looking at the law regarding taxation, federal income taxation at this point. Everyone goes to section 61 of the code. Section 61, just in brief, and I'm going to take a minute because I'm actually flipping to the code on my desk. But if I go to section 61, section 61 talks about, as I'm there right now, gross income defined. And everyone learns right off the bat that gross income is income from whatever source derived. So you don't even need to get into what all the different types are at this point. We just want to look at, what does the tax code say about gross income? And I'm not going to read them, but look at section 62, which is adjusted gross income. That's obviously something different than gross income because they define that differently. And if you go to section 63, you actually have something called taxable income. So in 3 different code sections, you have gross income, adjusted gross income, taxable income that you as a taxpayer or your representation, your CPA, your enrolled agent, has to be able to define what type of transaction falls into which of those categories. Are we talking about gross income? Are we talking about taxable income? What are we talking about? And before, like I said, one more before we go to trust taxation. If I go to section 1E of the code, that talks about tax imposed. It's got all the different rates of tax and everything else. You look at 1E and it says there's hereby imposed on the taxable income of every estate and every trust, taxable under the subsection, a tax, and it goes into the different calculations. So before we even talk about what these promoters are telling clients that do this type of trust, the general rule in the tax code is that if you have income, it's going to be taxable. If a trust has income, it's going to be taxable, unless we can find an exception to the general rules. And for those who are familiar with nonprofits and things of that sort, there is a specific section of the code in 501 that talks about if a trust falls under 501, it can be exempt from tax. But unless we're under 501, we have to start from the general position that everything that happens inside of a trust, inside of a corporation, inside of anything is going to be a taxable event to the taxpayer, which at this point is the trust. So we'll start there. As we move on then, the next part I'd like to read right before we jump into the section that is promoted heavily is I'd like to read section 641 subsection B of the tax code. I'll actually read both A and B because it's relevant to our discussion. Section 641A says that the tax imposed by section 1E, what I just read, shall apply to the taxable income of estates or any kind of property held in trust, including a laundry list of stuff. And remember, we just talked about the difference between all the different types of income. This is taxable income, so we have to keep our eyes on that, as I'll show you in a second. But subsection B, I think, is extremely relevant. The taxable income of an estate or trust shall be computed in the same manner as in the case of an individual, except as otherwise provided in this part. So again, we're starting from the point where, look, if the tax of a non-grantor trust is treated the same way as a tax to you, Dustin, or to me, then if I have a capital gain, I have to assume that that's a taxable capital gain at this point. I can't assume that it's going to be a non-taxable event unless we have an exception. Let's go to the language that many people say is the exception, and let's talk about why that isn't an exception in this case. So if we turn to section 643, this is the code section that is extremely mass marketed in all of these materials and everything else that I've seen across my desk. And 643, I'm going to read 2 different sections for us to start with, and then we can kick it around and talk about it at this point. 643 subsection A reads, distributable net income, which again is different than taxable income, different than adjusted gross income, different than all these things that we've read. Distributable net income says, for purposes of this part, the term distributable net income means, with respect to any taxable year, the taxable income of the estate or trust computed with the following modifications. So this code section is not saying anything about whether something is taxable or not taxable. What this code section is talking about is that if we have taxable income that's calculated in a certain way, we have this other calculation that is distributable net income. And the question becomes, is this that we're going to read about here in a second, is this included in distributable net income? For those people who aren't familiar with distributable net income, basically a non-grantor trust is a separate tax-paying entity, like a corporation or anything of the sort. So one of the exceptions to trust taxation is found in 2 different sections of the code. It's section 651 for simple trusts and section 661 and following for complex trusts. Complex trusts are trusts that are these asset protection type trusts. They are not required to distribute their income out. They can hold it, they can accumulate it, or they can distribute it out if the seas are calm and the beneficiaries have no asset protection concerns. And so what distributable net income is it's a calculation for a deduction against the taxable income of the trust. And the trust only gets a deduction for what the distributable net income is. So if you get a deduction at the trust level, which is often the case, you'll often have a portion of the taxable income that's eliminated, but there still usually remains some taxable income there at the trust level in some instances. So here, the code section that's often cited is 643, lowercase a, number 3, capital gains and losses. Gains from the sale or exchange of capital assets shall be excluded to the extent that such gains are allocated to corpus and are not paid, credited, or required to be distributed to any beneficiary during the taxable year, or paid, permanently set aside to be used for 642C and a whole laundry list of other things. So people say, look, 643A3 says gains from the sale or exchange of capital assets shall be excluded to the extent that such gains are allocated to corpus. But the question is what is it excluded from? Is it excluded from taxable income? No. We look at 643A and it's talking about distributable net income. Distributable net income is just to calculate your deduction. So if it's actually excluded from distributable net income, you're going to have a rude awakening when your trust has to pay those capital gains at that point because it's not pushed out to the given beneficiary. This is the problem that I'm seeing all across the board. And as we'll get to in a few minutes, my case study that's sitting here on my desk that I just had a chance to review, this gentleman sold multiple pieces of real estate in his discretionary non-grantor complex spendthrift trusts and used this code section to say, look, I don't have to pay any tax. And after having this discussion with him, now he's scared that he's going to be wearing that orange jumpsuit for tax fraud because this doesn't say that the sale of the real estate isn't taxable. It says that he is not going to get a K1 for those earnings coming out to him if we're relying on this code section. So these are the things that every taxpayer, every person who's done one of these trusts is going to have a rude awakening because the IRS has basically come out with a memorandum saying, this is what the tax code says, what I'm telling you today. And if you rely on this marketing material, at a minimum, you're going to be hit with penalties and interest for all of these years that you're not paying these taxes. And if it's substantial underreporting or other things of that sort, it could actually be much worse for you at that point. Well, let me tell you what happened in the case study, because I'll give you a couple other shocking points, because like I said, most of these things that are being promoted aren't necessarily wrong in and of themselves, but they're building like a glass house that's going to collapse on itself because they have some fundamental decisions with the tax code that are wrong. But I'll tell you what is even worse with this case study. So in this case study, we had the promoter create the complex non-grantor trust, put in $10. And this gentleman sold millions of dollars of depreciated low basis real estate inside of this trust and says there's no depreciation recapture, there's no tax, there's no nothing because I allocated it to corpus pursuant to these terms. The problem is that, again, and I've seen different groups do it differently out in the marketplace, but one of the major misconceptions here is the idea of what is the settlor of a trust. And one of the misconceptions is that if you read the document, which most untrained people do, they look at the document and they read the very first paragraph. And in this trust I'm staring at right now, it says this trust agreement is made of a certain date by and between person X as the settlor and person Y, who's the client, as the trustee, and same person as this. I'm not going to use the exact term so you don't know which group this is, but as trust protector or whoever it is that kind of oversees the activity of the trust. So my question to this client was, okay, so person X, the promoter, put in $10 and he signed the document as the settlor of the trust. I asked this client, I said, look, how did those millions of dollars of real estate actually get into the trust at that point? And his answer was, well, there were 4 transactions. One of them was a demand note. And in theory, that might be a way to get things into the trust without a gift or without what I'm going to tell you. But on the other three transactions, he simply deeded the property into the trust and then sold it out of the trust and things of that sort. So the problem is, and again, I wouldn't anticipate lay people to know this, but just because somebody signs as the settlor of the trust doesn't mean that there can't be multiple settlors of a trust at that point. And in this case, because we had the promoter put in $10 and we had the client put in $4 or $5 million of stuff, there's actually two different settlors of this trust, whether it's in writing or not. And if this gentleman put in the multiple millions of dollars of real estate and then sold the property, that can create other issues that if we want to go into, we'll go into, but in no particular order. This gentleman is a resident of a state that does not allow for something called self-settled trusts. Self-settled trusts are trusts that are asset protected type concepts where you create a trust, you transfer property to a trust, and you are the beneficiary of the trust. So it holds the assets in a protected state for you. Well, most of the states, I think it's at 38 or 39 states these days, do not allow you to do that. If you gift something to a trust and you are a beneficiary of the trust, most of the trust codes say your creditors can get at that trust every day for the rest of your life. There's no statute of limitations or anything of the sort. And so here, if your creditors can get at those assets, anything that you've built up wealth-wise or whatever inside of this trust under another code section 2036 gets all brought back into your estate at the time of your death. So we have estate inclusion with this trust. That's number one. But that's not the worst case scenario. So number two, what's going to shock this client is that I'm going to tell them, look, because you only sold one of those properties and you just deeded the other three in, you are a settlor of the trust. And under multiple code sections of the code, this is no longer a non-grantor trust. He actually, even though it says it's a non-grantor trust, it's actually a grantor trust under 3 or 4 different code sections. And so because of that, all of these gains and losses that he should have reported on a trust tax return actually should have been reported on his own personal return at that point. And he's going to be the one, not this trust. He's going to be the one. Penalties, interest, and maybe the orange jumpsuit. I don't know. We'll find out at that point. So that's number two. And then number three, I told him as well, look, if you just transferred things in, where's your gift tax returns? Because again, you actually have, if you haven't sold something to the trust in exchange for a promissory note or consideration to the trust, you actually are considered to have made taxable gifts. And that's a misnomer because taxable gifts are usually covered by some time exemption, that there isn't actually a tax due, but they are taxable gifts that the government makes you account for how much you can transfer throughout your lifetime. And this gentleman didn't do any gift tax returns either. So all of those different contexts are even worse in this specific case study because this gentleman thought it was a complex non-grantor discretionary spendthrift trust when he administered it wrong. It was improperly taking into account the code sections we cited, and he's got a world of hurt in a number of different areas that are going to have to be unpacked issue by issue, and it's not going to be an easy unpacking. It's going to have to involve, a lot of different pain points to get right with the IRS at this point.
Mark, you brought up one term. I really, really need you to touch on this. So you said promoter. Why is it so important to know that these people are promoter if you are a purchaser of one of these trusts?
Well, it's often important because sometimes, again, it depends on how gracious the IRS is acting in any given point. But oftentimes, if there is a promoter promoting things out in the marketplace and things like that, sometimes the IRS will look at that and say, yes, you were misled. This was a Ponzi scheme. This was whatever it is. And we might show you some mercy with regard to penalties if you took this and you relied on these representations by the promoter at this point. It also creates maybe some litigation targets and things of that sort. The problem that many of these clients are going to run into, though, is that at least with many of the people across the country that I've spoken with, it wasn't just the client that got the wool pulled over their eyes, but it was actually the CPA, the enrolled agent, the other people involved. And if that's the case, well, I mean, again, the IRS is going to say, look, you had, counsel tell you that this was right or whatever it was. It's not right. It's absolutely wrong. And the IRS brought out its own memorandum to the public to say that that's wrong at this point. But again, you should have relied on counsel, these people, your enrolled agent, your CPA, whoever, to properly advise you. So go take it up with them. Here's your penalties, here's your interest, and pay the government at this point. So many of these, it's really going to come down to how benevolent the IRS is feeling those at that time. But yeah, I think that there's going to be a lot of people crying, hey, this is a promoter, they're defrauding the public, whatever it is. And anybody who are pushing these trusts, which in a vacuum, they're fine trusts, like I said, but pushing the interpretation of the tax code on these types of trusts, I think that, again, there'll be some class action lawsuits, there'll be some things going on. It's going to be painful for everyone involved, but clients who have gone through these things need to immediately consider, do they self-report? Do they correct some of the things that were not reported the right way? Do they pay their penalties and interests? Do they have to fall on the sword and just kind of approach the IRS and say, look, my bad, I was misled, whatever it is? I think every case is going to be a little bit different here, but the problem is that doing nothing, you're basically leaving yourself wide open on a number of fronts, because again, maybe some people put mega millions into some of these trusts. One of the things is that the statute of limitations on a gift never runs at all unless you file a gift tax return. It could be 50 years later. And if it's, again, one of these cases that I just talked about, one of these non-grantor trusts that might be construed to be a grantor trust, is that a substantial under-reporting on your personal return that might extend the statute for you? It's all going to be facts and circumstances in each case, but like I said, for the handful of people that I've started talking to about how to unwind things and fix these things, it's been super painful for every one of them so far, and I don't think it's going to get any better for these given clients.
That was my last question. So if someone has something like this, what do they do?
I think you need to come up with a team that, if you don't have an advisory team already, you need to have a competent team. And I say competent because, like I said, many people who did this probably felt they had a team already. They had an enrolled agent, they had a CPA, they had whoever. And again, I can't imagine, although actually I do know of many, I can't imagine a CPA falling for this, but they did. And so it's one of these deals where if your advisors fell for this and told you this is great, you should do this, you really have to give a second thought about whether you should continue to work with those advisors, because you're probably not getting good advice at this point. So step one will be assemble a proper team that can actually tell you what you're getting into, tell you what you're doing, and advise you on how to right the ship. This is the Titanic heading for an iceberg, or maybe you're already scraping the bottom and you just don't know it yet, and you might be going down. And again, if you self-report and stuff like that, maybe they take some mercy on you. If you don't want to, you at least need to get with an attorney under attorney-client privilege and say, look, what is going on with regard to my situation? How many years did I not report or underreport? What was the tax that wasn't paid in those years? What's the potential penalties and interest and things like that? You're going to have some hard discussions with someone underprivileged to make sure that that is first evaluated. And then with the proper team in place, correct it and get yourself right before, the floodgates open here and the IRS starts coming after a lot of these people in this way.
Well, Mark, I'm jealous you're in Hawaii, but hope everything's treating you well over there. That's been episode 4, and appreciate you guys for listening in. And if you didn't know, we do settle these types of trusts. So if you'd like to get a hold of us, just send me an email. I'll put my email in the description. And besides that, I'll leave you to it.
Thank you.